Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the US dollar and gold and the impact that the Fed Reserve's interest rate decision can have upon these instruments and the opportunities this can create for traders. My name is Sasha and I'm a financial analyst from the research department at ForTrade. I'm pleased that you're watching our webinars. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. But before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. So first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's solely your decision whether you trade on market opportunities or not. So here's an example of a recent market opportunity. You can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the partner situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position. That's had you chosen to trade on this opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further across. At these points you can put a stop loss and take profit, and on the right hand side of the screen you have calculations. If you close the position using take profit, you can expect these kinds of profits at these support levels in green. If the price is going against you, then you can potentially have a loss of the amount at the resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So there are many factors that influence the dollar and gold prices, but the main ones you can see in front of you. Interest rates, economic releases such as the NFP, geopolitical events like the trade war, market sentiment, and company earnings. Perhaps the most important factor is interest rate set by the Fed. A higher interest rate or anticipated interest rate tends to increase the value of the dollar and bring gold prices down, and vice versa. The Fed meeting is due this Wednesday on May the 1st. The most important economic releases primarily influence the dollar and gold to some extent. For example, a good or above expectations NFP or jobs report tends to push the dollar higher, which causes gold to become cheaper, due to the fact that it's priced in dollars. The NFP, by the way, will also take place this Friday on May the 3rd. Geopolitical events such as the trade war also impact gold and US dollar currency pairs. Trade war tensions and tariffs tend to push the US dollar up due to that currency's safe haven status. On the other hand, gold is more likely to rise when situations are unstable or tariffs are being imposed. As a safe haven instrument, investors tend to buy less risky assets like gold in times of tension or uncertainty. Market sentiment. Market sentiment is the general mood of the market. If market sentiment is positive, intenders tend to be confident and put their money into instruments such as stocks. But if market sentiment is negative, they are more likely to invest in gold. Company earnings. As with market sentiment, good company earnings tend to push stock prices higher, putting pressure on gold. We are in the middle of an earnings season at the moment, so it's certainly worth watching out for the potential impact on the market. As I'm sure many of you know, the dollar and gold tend to move in opposite directions. So if you want to reduce risk, you might consider hedging one against the other. So this week we have both the Fed meeting and the NFP. It will be a very important week for US currency pairs as the key US manufacturing data and consumer confidence will also be released. But let's take a look at the most important factor this week, the Fed. As we all know, the Federal Reserve is the central banking system of the US that implements monetary policy. The current chair is Jerome Powell, but although Powell is a Trump appointee, he has faced unprecedented criticism from the president, who has clearly expressed his dissatisfaction as interest rates have slowly risen. The FOMC is the body that makes important decisions on monetary policy by raising or lowering its target for federal funds rate. This has a great impact on the price of the dollar. So the Federal Reserve's mandate is a dual one: to keep inflation below or close to 2% and to create jobs. And it does this with monetary policy, setting interest rates. You can see on this table how the Fed has kept interest rates historically low as medicine to kickstart the economy following the financial crisis. But as the US and global economy has strengthened in recent years, you can see how over the past 2 years, rates have increased to today's rate at the end of the graph. That's 2.5%. So the previous Federal Open Market Committee, or FOMC, meeting took place on March the 20th. The interest rate was kept at 2.5% in line with analysts' expectations. The previous interest rate hike of 0.25% took place in December last year. The decision to maintain interest rates was unanimous, but members indicated that the pace of rate hikes would be data-driven and would be kept steady for now. Upon the announcement of the expected decision, the euro-dollar jumped by almost 1% before moving back down slightly to end the day 0.66% up. This growth of the currency pair wasn't due to the Fed's decision to keep interest rates on hold. It was due to the Fed indicating that there will be no more rate hikes coming this year. The Fed reduced expectations for future GDP growth and inflation too, all confirming a dovish tone in its policy. And as we would expect, this pushed the euro-dollar higher as the dollar fell against a basket of other currencies. Some analysts again outlined that although it's most likely that there will be no action by the Fed on interest rates this year, there is a greater chance of a Fed cut than an increase. This also factored into traders' decision to buy the euro-dollar. On April the 10th, the minutes of the Fed meeting were published, where officials outlined their concerns about slowing economic growth and the fading effect of President Trump's tax cuts. Some officials noted that rates could move in either direction. However, the majority repeated the position that any change would have to be data-driven, implying that rates will remain unchanged for the foreseeable future. So what can we expect at this meeting? The US Central Bank is expected to keep interest rates at 2.5% when it meets on May the 1st. As you can see, there is a 99.5% probability, according to CME Group, that rates will remain in the current target range of 2.25% to 2.5%. This month's Fed interest rate decision comes as the dollar is trading at a yearly high. Despite the global slowdown, economic data from the US has remained positive, and fears from some economists that the slowdown and trade war would cause the US to grow far more slowly have not been realized. The greenback has also benefited from its safe haven status, as its main rivals such as the pound with its Brexit volatility and the Eurozone with its economic slowdown have caused those currencies to fall or stagnate. Rising Treasury yields have also supported the dollar. Since it's extremely likely that interest rates will remain steady, Investors will be on the lookout for clues on the movement of rates in the future, and will be watching Chairman Powell. Since economic results have held steady, any hint of a possible more hawkish position could push the dollar up. But no surprises are anticipated, and many analysts believe the current Fed position of no hikes has been baked in. As far as the NFP is concerned, markets are expecting 196,000 new jobs to be created. A figure lower than this may cause the dollar to fall back on Friday, although investors should also watch out for average earnings figures, which are expected to record an increase of 0.3%. If the figure is less than this, it may put pressure on the dollar. Well, I hope you found this webinar useful. Of course, at ForeTrade we'll be following developments related to both the Fed decision, the NFP, and other economic data for what we expect will be a very busy week's trading. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForeTrade again soon.